Good morning. It's Friday, the 28th of March, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming from a warm Mumbai, India's financial capital. The top stories and themes, and a quick reminder that Monday is a markets holiday, and therefore we won't have an edition, but we will have a special edition for which you should watch out. The markets survive a fresh volley of tariff fire. How foreign institutional investors continue to drive sentiment and price movements. Goldman Sachs raises its year-end gold price target to $3,300 per ounce. India is now facing tariff impact on auto components, steel and aluminum from the United States. What's next? The Indian media and entertainment industry revenues fell 3% last year, even as digital advertising grew 17% or 55% of total.
This is a core report with Govindraj Ethiraj.
The markets hang in there. US President Donald Trump unveiled a 25% tariff on imported vehicles, expanding a global trade war and, of course, sending stocks into a fresh tizzy. The new duties on cars and light trucks will kick in on April 3rd. That's one day after he said he will announce reciprocal tariffs aimed at countries he says are responsible for the bulk of the United States trade deficit, and that includes India. Now, Indian auto components companies will take a bigger hit, and more on that shortly. But amazingly, all of this did nothing to the markets, who seem a little bored almost with Trump's repeated threats, despite the fact that he is actually seeing them through in some form or the other. And thus, the indices closed higher on Thursday, despite opening on a weaker note. And I say despite because this is somewhat unusual in recent times, and in some ways also reflects a certain degree of underlying strength in the market right now. Of course, we have to see whether it will last. The 30 stock Sensex added about 317 points to close at 77,606. The Nifty 50 was up 105 points to close at 23,591. Small cap shares were up. The Nifty Small Cap 100 was up by over 1%. The Nifty Midcap was up by about 0.4%. So Tata Motors and the auto parts makers that supplied Tesla, among others, fell on Thursday. After those 25% tariff announcements, Tata Motors fell about 5%, and Tesla's biggest Indian supplier, that's Sona Comstar, also dropped 4%, and that led to a 1.2% drop in the auto sector, according to Reuters. Importantly, the United States is a key destination for Tata Motors' owned Jaguar Land Rovers luxury cars, which are imported from plants in the United Kingdom and Slovakia. Among other stocks, Samvardhana Motherson, India's biggest auto parts supplier, fell 2%. Bharat Forge, which also supplies Tesla, was down 0.4%. Meanwhile, one announcement that could keep market spirits on the higher side is a likely move by India's Reserve Bank to double the 10% cap on investment in a listed company by individual foreign investors, according to an exclusive Reuters report. Now, that's up from the 5% holding in an Indian company allowed to overseas Indian citizens by special rules under the Foreign Exchange Management Act. Current foreign exchange management rules only mention non-resident Indians and overseas citizens of India under Schedule 3, a government official told Reuters, and now they would broaden this to include all individual foreign investors. Foreign investors have pulled out about $28 billion from Indian stocks since September's record high in the benchmark NSE Nifty 50. Of course, all of that is just reversed literally days ago. Now, the thinking in the past has been that institutional investors, in a way, are more reliable and predictable, as in they come in and invest long-term money, and individual investors, which could apply to investors anywhere in the world, may or rather pull out money if things turn. So now what India is doing is expanding the definition to include individual foreign investors to maybe balance out institutional foreign investors. How that could play out, I'm not very sure, but it's definitely a forward move given that markets are now more open and there's more funds coming in. So I reached out to Ajay Bagga, veteran investor and market analyst, and I began by asking him how and why even small amounts of foreign portfolio investment continue to drive turnaround in sentiment. And that's actually in both directions, though right now we're talking about the upward direction, and also his overall sense on flows between India and China and the region as well as across the world.
To contextualize it, Govind, we have seen very heavy selling for the last 5 months. So from September 24th, 26th, when we peaked, that time $50,000 went to China over 2 weeks' time, and we saw money going out of India. We thought that trend would reverse, but it's taken 5 months for that trend to actually reverse. So what has helped is, one, after 5 months of falling, the markets have had a positive month in March, and 5 months together of successive market fall hadn't happened since 1996. So you can just see that in context that in 29 years, we have not had 5 successive months of negative returns on the markets. And those were largely because of foreign portfolio investors' outflows, because domestic flows kept coming. So that way it becomes important that there was a turnaround. What we have seen, Govind, in March, that finally that intensity of selling started to get lower, and then the number turned positive. It's not that huge amounts have come, unlike what we saw in September last year when we reached the all-time highs. That was a peak of inflows. And then a month in December, we had seen some flows coming in towards the year end, but overall we have seen a negative. But because the intensity reduced, the domestic flows could make an impact, and that kind of selling was not happening. So that has helped the markets. But overall, apart from the flows, what has happened in the backdrop is the domestic macro has probably bottomed out in September. Corporate earnings have probably bottomed out in December, and we are going to see double-digit corporate earnings growth for the next 4 quarters. That's what seems to be the consensus. We are looking at about 1,040 rupees EPS of Nifty going to 1,200 rupees plus in the next financial year, going to about 1360 to 1380 by FY 2027. So what happens is in another 3 months, Govind, the 1 year forward will then move to FY 2027. So fundamentally also the market is better off. RBI new governor has come in with a lot of monetary easing, a three-pronged approach: rate cut, liquidity injection, macroprudential easing. And then inflation coming down because of seasonality on the food inflation part. That has helped as well.
To come back to the foreign portfolio investors, so I'm just trying to understand. You pointed out, that we've not really seen this kind of selling in 29 years. Now, what is it that we can take away from the nature of investing and the market itself, given that FIs are still, in a way, determining the flows? I think, for example, maybe 6 months ago, there was confidence that FIs are not going to determine the direction of the market. But at least the events of the last few weeks seems to suggest that they are. And if there is a turnaround, at least some part of it is, if there is a turnaround in the markets, some part of it is being driven by them. So I'm just trying to understand, is it the nature of their investments, it's their stock selection and the research that they bring in, which causes these shifts or turns?
One is the sentiment, Govind, because it's a number that's seen every day. So the marginal HNI, the marginal proprietary desk gets influenced by that number. Second, as you said, they are still 16 to 18% of our market, depending on the data point when we are seeing it. So they are quite important. And third, the promoter stocks don't come into the market. So as far as the free float goes, they have an inordinately high proportion, especially in the large weightages in the market. So in the large caps or the bigger part of the mid caps, they could be quite market moving. Fourth is that in terms of allocations, there is decent amount of that FI money which is coming through ETFs, which is coming through global emerging market funds, or which is leveraged money which goes out as fast. So when that money goes out, we have seen about $28 billion going out from September end till today. So that 28 billion shouldn't have made a difference to a $5.3 trillion market. You would say, okay, 900 billion is their holding. What if 2.28 billion went out? It's hardly not even 3%. So why did it make such a big difference? In the free float part, they are quite big. Second, it comes as an intense selling. Third, what I have seen running money in India, our fund managers, when I would be working for an Indian fund manager, we would make sure the impact cost is managed. We will not just sell. But if you are working for Frankfurt or New York or Boston, the thing will be everything must go right now. So the price damage is much higher. That's what is my personal experience, but that's anecdotal. So when the top down comes from Hong Kong or Singapore, some trader of a leverage fund, a hedge fund is clearing his position or creating liquidity, then they don't really watch out for the impact cost. An Indian fund manager will distribute out his selling and will not be so pressurized. I worked for both Indian and MNC fund managers. That was my anecdotal experience.
Right. I know you track flows across the region very closely. So, I mean, we've seen, for example, a lot of funds going into China after the DeepSeek announcement. And even today, there is disproportionate flow towards AI stocks and tech stocks in China and not so much other stocks. So, what's your sense of flows in the region in general, or maybe in other parts of the world, versus India and India's sort of continued, or rather likelihood of getting continued flows?
A large portion of flows went into China. China this year has got about $13 billion already in the first 3 months. And that is very creditable. They did four things very right, and they came in with a very strong four-pronged strategy. One, Xi Jinping actually met the private companies. They had gone out of favor after they made the Alibaba Jack Ma disappear. Xi was frowning on the prima donnas of the Chinese tech industry. He embraced them. He met all of them, and that helped set the sentiment. Second, they were able to very nicely monetize their DeepSeek launch. So monetization of Chinese tech happened, and a lot of money, which was bidding up the magnificent seven big tech in US, started seeing that maybe we should allocate into the Chinese tech. There is some monetization. Third was their stimulus measures, which they kept on doing. And fourth was injecting liquidity. In the end, liquidity is oxygen to the markets. What the RBI governor did for us, you are seeing that turnaround happening, because having a tight liquidity is as good as starving the markets of oxygen. If you see this time around, the Fed did a stealth easing because they cut down the QT from 25 billion a month to 5 billion. So that was the stealth easing of monetary policy that was done. You're putting in $20 billion of liquidity in the US market. So same thing China also did. So government policy, stimulus, monetization of technology, and fourth was the liquidity injection. And boom, you got 13 billion. There are some other pockets which have got money regularly, but largely emerging markets were starved of capital. A large portion of that incremental money, Govind, has gone into US money market funds. So, which were like $5.5 trillion have gone up to 7 trillion. So, because you are still making 4% plus in a dollar asset, and if you leverage it up, borrow short and put money there, you're making good dollar returns. So on the average, the incremental flows were going into US money markets. That was what was hurting. Then the dollar falling from 109 to 104 on the dollar index has also helped. So that incremental flow is coming to emerging markets. India, the flows have restarted in March. We are expecting it will pick up in May, June as the next quarter's earnings start being talked about in operational results. And then I think you should see a flurry of interest. But definitely the money coming out of US equities into emerging markets, that trend has started. China has been the major beneficiary so far. We are expecting India to follow. Europe has got a lot of that money, but that's a developed market. But Europe has done very well. It is an outperforming market year to date, up some 14, 15, top 100 index. Because of their defense expenditure, an austere economy like Germany putting in a 5 billion euro bid on stimulus and on rebuilding its defenses. So we have seen defense and euro banks really take off because of the stimulus that the European economies are bringing in.
Ajay, thank you so much for joining me and sharing your thoughts.
Thanks very much, Govind. Thanks for having me.
Gold still rises. Gold prices rose on Thursday. The United States hiked those auto tariffs ahead of an April 2nd deadline for reciprocal tariffs. Spot gold was up to about $3,036 an ounce, and prices had, if you recall, hit a high of $3,057 on March 20th. Gold futures were up as well. Importantly, Goldman Sachs on Wednesday has raised its end 2025 gold price forecast from $3,100 to now $3,300 per ounce, citing stronger than expected ETF or exchange traded fund inflows and sustained central bank demand, according to Reuters. Analysts told Reuters also that they expect gold to breach the $3,100 mark in the second quarter, and the market could potentially push another 8 to 10% higher by end 2025 if the current macro and physical market tailwinds sustain for the yellow metal. An interest rate cut is around the corner. The Reserve Bank of India will cut interest rates at a second straight meeting in April 9th, with just one more cut expected in August, which could mark the shortest easing cycle on record, according to a Reuters poll of economists. With inflation in India easing to a 7-month low of 3.6% in February, and the economy forecast to grow at about 6.4%, which is the weakest in 4 years, the central bank does have room now to cut rates further. And on the other hand, there is, of course, expectation that the central bank will cut rates and give a general boost to the economy. According to that Reuters poll, a strong majority of them, 54 of 60, in that poll conducted between March 18th and 27th, that yesterday expected the Reserve Bank to cut its benchmark repo rate by 25 basis points to 6% at the conclusion of its April 7th to 9th meeting. One economist told Reuters that there are not many strong growth drivers going into fiscal year 26, and the Reserve Bank need to sustain their support to growth. Inflation has also created a room for them to ease, and they should utilize that space to recalibrate monetary policy. As we heard earlier as well from Ajay Bagga, the Reserve Bank of India has been injecting liquidity into the banking system over the last few months to increase money supply. There are some questions which often arise on transmission of these interest rates and liquidity to lower rates of the kind that you and I can feel. Another economist told Reuters that if transmission needs to happen, especially in a rate cutting cycle, banking sector liquidity needs to be on the positive side. The tariff war continues. Indian auto component makers are more likely to be impacted than vehicle manufacturers by the latest round of tariffs announced by US President Trump. Trump on Wednesday announced the imposition of a 25% tariff on auto imports that includes passenger vehicles and light trucks, with another 25% tariff expected to be applied on imports of most major automotive parts, that's engine and engine parts, transmissions and powertrains and electrical components, by May. India exported around $9 million, that's 9, or around 75 crore rupees of passenger vehicles to the US from the figures that I could get, but the components industry was worth close to $6.8 billion last year, while India's imports from the US stood at about $1.4 billion at 15% duty. Prior to this announcement, the US charged zero duty on imported components, or close to zero duty. Now, I reached out to Ajay Srivastava, former Director General of Foreign Trade official and founder of the Global Trade Research Institute, and I began by asking him where things stood right now in the context of the discussions going on, particularly by line item, and where we were headed, or more importantly, should be headed in coming days.
So as things stand today, Trump is hitting us with tariffs on two sectors. Auto sector, he announced yesterday only, auto and auto components, and steel aluminium announced 2 weeks back. So these are the sectors on which tariffs have already been announced or implemented on us. There are no country-specific tariffs like imposed on Canada or China. So we are awaiting for April 2 big bang announcements by Mr. Trump. To expect that India may escape because Trump is hinting is that, I'll not be a happy person because it's about tariffs. This is not against India. It's about his whole of the world strategy, right or wrong. And he has been naming India repeatedly as tariff abuser, tariff king. And so I'll be really surprised if he exempts us from any more applications of the tariff than he does on other countries. And that will say only one thing, that they have been able to negotiate deal which compensates for whatever his perception about Indian tariff is there. And that will go beyond tariffs. That's what my worry is.
So if you were to look at some of the announcements that we've been seeing, and India has already taken some steps, for example, on motorcycles or high-end motorcycles, possibly on whiskey or bourbon. And just yesterday, the government has said that they're going to remove this tax on ad spends, that digital ad spends. That's a 6% equalization levy. So these are all various steps. which will hopefully go into making a larger package to appease the US government. So, what's your sense if you, again, going back to line items?
So I said Trump is about tariffs and we should fight the tariffs. Tariffs have limited impact, especially in Trump's case when he's putting tariffs on everybody. Everybody will be at equal disadvantage, more or less equal disadvantage. Then nobody will be seriously hurt if that happens. But if we start appeasing him by giving concessions on other areas, deeper areas in quick succession, then I think we may be taking on bigger things on us, bigger burdens on us than tariff would ever put on us.
I noticed that you've not mentioned any line items, but if I were to ask you going forward, what would your strategy be at this point if you were sitting on that negotiating table?
So, Govind, I am very clear that 95% of US exports to India, they are industrial goods. 95%. And India is in position to offer tariff-free entry to US industrial goods. 90% of the US industrial goods, tariff-free entry from day one. So I'm very clear that Indian government should make such a list and hand it over to US immediately today, tomorrow, day after tomorrow, before April 2. I'm saying this with full confidence that these are the items we are already allowing for more than a decade from our FTA partners like Japan, South Korea, ASEAN countries. And these are very competitive economies, far more competitive on industrial goods than US ever is or will be in near future. So when we can get our industry has fully absorbed zero tariff imports from these economies, with opening these to US will not hurt any of our sectors. So I think we should give that to US. We should not open auto sector. We should not touch the agriculture at this point of time.
From what I've been hearing, agriculture and dairy are or should be out of the table. But I don't know how the US government will respond in that, because that's an area where the US will be very keen. For example, soybean exports or dairy exports from the US to India, and they have capacity. So, how would we respond then?
So if he is talking about you're not allowing our trade, we say we are allowing zero tariff on your most trade, more than 90% of the trade. That should satisfy him. Why he's talking about agriculture is that he knows that we have not opened agriculture to most of our FTA partners. That's why they are intelligent people. They anticipate that India will be easy on industrial goods like we are talking right now and tough on agriculture goods. That's why they are not even talking about industrial goods, they're talking about agriculture goods. But I think our leadership is very clear that agriculture is a sensitive subject for us. It's a livelihood issue. It's not a trade issue. 700 million people, their livelihood is dependent on agriculture. US agriculture demands are not about tariffs alone. They don't like our MSP scheme that will disrupt the PDS system, that will affect the poor directly. They have problems with stopping dairy imports if the animal has been fed with meat or blood things. These are our cultural sensitivities, so we have reasons to stop these. Point is, they are going beyond the tariffs in agriculture. As I say, it's not a trade subject for us. They should understand. I think they're intelligent, they may understand. If they don't understand, we say, okay, impose tariffs, we'll face it.
Coming back to industrial products, you said 95% of our imports are industrial products. And the same industrial products we are getting at zero tariff, I'm assuming, because we have free trade agreements with some of these Asian countries. Now, how is it that we're importing so much from the US then? I mean, is it because of specific brands or specific product categories?
It's a great question, Govinda. I would have loved to answer this. So what we import from US is crude petroleum, that is our crude oil, $4.5 billion. Then petroleum products, $3.2 billion. Then steam coal is steam and coking coal, $3.4 billion. Then cut and polished diamonds, $2.6 billion. Gold, $1.3 billion. And waste and scrap, $4 billion. So if we total this, this amounts to about 60% of US exports to India. So US is into either agricultural commodities or into these low-end commoditized products or very high-end products like they will make aircraft parts, semiconductors, those things. But bulk of the industrial products, they are simply absent. They are not competitive. It's not that India is not taking, they don't make it competitively. So even if we open it, they won't be able to supply much. That's why I read this, the items which we import from US.
And you're saying, therefore, their thrust is going to be to make us open up in areas where clearly going back to agriculture and dairy.
That's the approach. But they don't realize that we may not consume soybean too much and those things are there. And agriculture is, as I say, it's not a trade issue at all with us. many inefficiencies are there, plot size is low, and productivity is low. We cannot risk putting the lives of half the population in danger.
Right. Mr. Srivastava, thank you so much for joining me.
Thank you, Govind. Thank you.
Meanwhile, Germany's economy minister, as well as the industry, blasted US President Trump's plans to impose those 25% tariffs, saying the move sends a fatal signal to free and rules-based trade, according to CNBC. German economy minister Robert Habeck called for the European Union to provide a decisive response to Trump's latest tariff announcement, saying the levies ultimately harm the US and the EU and global trade as a whole. The announcement of high tariffs on cars and car parts is bad news for German car makers, for the German economy, for the EU, but also for the US, Habeck said Thursday in a Google translated statement. It is now crucial that the EU delivers a decisive response to the tariffs. It must be clear that we will not back down in the face of the US. Strength and self-confidence are required, he added in that report quoted by CNBC. Elsewhere, Japan has also reacted quite strongly, saying that it was a big investor in the US and did not deserve to be treated in this fashion, which is the imposition of tariffs on Japanese car exports into the US. And more on all of that, I'm sure, in coming days. Meanwhile, US tariffs on copper imports are also coming in weeks as opposed to months, which was expected earlier, thanks to which copper has been trading at a record high in New York. The Indian media and entertainment industry slows. India's media and entertainment industry earned about 250,000 crores in revenue in 2024, but that number was 3% or 3.3% to be specific, lower than the previous year as it undergoes rapid transformation, according to a new report out by Ernst & Young and FIIs, the industry body. The report said that growth slowed due to falling subscription revenues and a global decline in animation and VFX, so that's visual effects work outsourced to India. The industry contributed about 0.7% of India's GDP and is expected to now grow 7.2% to be worth about 268,000 crores in 25. Advertising grew about 8.1%, events grew 15%, and on the negative side, subscription income went down. That's across TV and print, according to Ernst & Young. Pay TV lost about 6 to 7 million homes, bringing down subscription revenues as people moved to digital mediums like YouTube, they said. Box office overall was weak, which saw a 5.6% drop in revenues. There was a fall in transaction gaming revenues after implementation of higher GST or goods and service tax on real money games. A strike by Hollywood scriptwriters in 2023 and struggling international studios led to a 9% revenue decline in 2024 and reduced broadcast ad revenues, affecting the production of animated content in India, the report said. The good news, digital advertising in 2024 grew 17% to 70,000 crores, which is now 55% of total advertising revenues and driven by social media and e-commerce ad. Now, that's obviously good news for those who are in the digital media industry. Other segments that grew was OOH or out-of-home advertising media, which grew 10%, digital out-of-home grew 78%, and radio revenues grew 9% to 2,500 crore thanks to growth in ad volumes and alternate revenue streams. Print advertisement revenues grew 1% in 2024, with premium ad formats driving growth. Li Ka-shing faces the ire of the Chinese government. Li Ka-shing is an interesting story because there is a strong Indian connection and it's more perhaps visible than you think. Li Ka-shing was born in 1928, emigrated to Hong Kong from mainland China in 1940, and we'll come to his businesses and the current news in a moment. He started as a salesman, founding his own plastics company, then invested in real estate and became Hong Kong's largest real estate developer. In 1979, he acquired the conglomerate Hutchison Whampoa, and he had two sons, the youngest of whom, Richard, launched a satellite programming venture in 1991 focused on 38 nations in Asia and the Middle East. And that satellite venture was called Star TV, which was then subsequently acquired by Murdoch and then sold to Disney, which is now partnered with Reliance. So there you are. Now, to come back to Li Ka-shing's current problems, China has told state-owned firms to hold off any new collaboration with businesses linked to Li Ka-shing and his family after the Hong Kong billionaire angered Beijing with his plan to sell 2 Panama ports to a global consortium. The directive was issued to state-owned enterprises last week at the behest of senior officials, Bloomberg reported, though they added that existing tie-ups are not affected. The 96-year-old billionaire, if you haven't done the math already, struck a deal with BlackRock Inc., or rather a consortium led by BlackRock, to sell ports in Panama and elsewhere to the United States effectively, and thus putting his conglomerate's entity in the crosshairs of US-China relations. The port sale is expected to net CK Hutchison, his company, more than $19 billion in cash proceeds, and it triggered response in Beijing after Trump hailed it as the US reclaiming the strategic waterway from Chinese influence, though the Panama ports are just 2 of 43 facilities being divested globally. Before we go for our long holidays, remember Monday is a markets holiday and we have no edition on that day, though we do have a special edition. So do watch out for that. And here's some feedback that we look forward to and love to hear. And thank you once again in advance. Jordan Bordeaux says that this was fantastic. I usually listen to American financial news, and after listening to this show, I realized I need to listen to more Indian financial news. Keep up the good work and thoughts and prayers from America to my Indian brothers and sisters preparing for another heat wave. Stay safe. Thank you, Jordan, for those thoughtful words indeed, and all our best wishes for you and your work and everyone at home. Pallav Ved says, very informative. Mr. X per X says, I think this channel will reach 100,000 subscribers this year. It's highly underrated. Thank you very much, Mr. X per X. Spread Only Love says, good coverage on Air India, soy oil, and India doing away with Google tax. Thank you very much. That was our latest edition, which you're referring to. And Mr. X per X again says, DBS in Singapore is truly a wonderful experience. Thank you very much, all of you, once again, and have a great weekend and see you next week. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.